Big money, like like Warren Buffett. I mean, when he bought silver, he bought 129.7 million ounces of silver off the COMEX, and he bought silver because buying Pan American, they would have taken the price to the moon. But pension funds, family offices, or whatever, they'll be looking at the silver Wheatons, the Agnico Eagles, the Pan Americans, those type of things, because those are, billion-dollar, multi-billion-dollar companies that they can buy because they're liquid enough. But when silver runs, as you said, Jordan, there'll be any 5 cent, 7 cent, 12 cent stock that claims to be exploring for silver will take off. What happens is a psychological event. And people that are late to the party particularly will be looking for the cheapest silver stock they can buy. And there'll be a lot of others that are like mine. So you will see anything with silver in the stand. Gold as well. I think they'll move together. They always do. And so what will happen is in those juniors, you will see a speculative frenzy. Now there's some juniors of merit, so you kind of got to divide the wheat from the chaff. But as a general rule, high tide raises all boats. So from the moose pasture to the best, they're all going to go up. I just got a chart up here real quick. And I think it'll be next year still. Could be this year. No one knows. But you actually prefer to see it go up, I wouldn't say slowly, but steadily. Because again, once you get a parabolic move, then you've got a problem. It's going to come right back down. It's like throwing a basket, throwing a ball in the air. It goes up and it hits equilibrium where it stalls out to static for just a tenth of a second, and then it starts down. That's not the case if you built a stair-step structure all the way up. So I'm very anxious to see what it does in the 40s. Does it go from 40 to 45 to 50, or that goes to 40, 42, builds a base for 3 months, and then drops back down to 40 and tests it, comes right back to 42, and then it moves up to 45 all of a sudden. I mean, wait a minute, I should have bought it at 42. I thought that was the top price, and then builds a base there or whatever. So I don't know the character of the market. What I do know is past history, what we're talking today, and we already agreed, building those bases is very important.
History provides a roadmap. In 1980, silver skyrocketed from under $20 to nearly $50 an ounce, a gain of more than 300% in just a year. Yet the spike was short-lived, with prices collapsing soon after. That boom-bust cycle showed how quickly fear and greed shaped this volatile market. Today, some analysts argue silver could overshoot to extreme levels again, perhaps $200 or more, before settling into a new equilibrium. The real value might stabilize much lower, around $80 to $100, but like 1980, investors could see wild swings before a steady range is finally established.
And so I'm more favorable actually to that. I'd rather get there where it's sustainable. And I just got some members' questions, from my members, and two of them basically asked the same question, what's it going to look like? And I said, it's going to look like another spike. I mean, silver and many markets, but particularly silver, has a propensity to do these spike highs and spike lows. And I do believe that's what will happen. But going back to 1980, I just did an update or my weekly perspective on what happened in 1980. It was an intraday high at 50, but what I said was that it repriced for about 300% from what it had been the year before. And I think we'll see the same thing. So for talking purposes only, we could get to an overshoot, whatever that is. Let's say $200 silver. Maybe it should be 2,000. I don't know. The market knows more than I do. But let's just say 200 for talking purposes. And let's say the equilibrium price is, 100. So it could go to 200, trade there for a few days, a few hours, a few minutes, I don't know, but not for very long. Starts down, people start getting scared. Oh my gosh, I missed the top, I better sell, take it. So you get some selling pressure and it drops to, I just said 100, but 150 or some other number.
Silver isn't just money or jewelry, it's a critical industrial metal. From solar panels to smartphones, it powers technologies we use every day. And here's the key. Manufacturers can't easily replace silver, Even at $120 an ounce, the cost per product remains small compared to the final price of a refrigerator, phone, or car. This makes silver inelastic. Demand stays strong regardless of price. While consumers may grumble, industry will keep buying, ensuring a solid demand floor. That's why investors see silver differently than purely speculative assets. It's both a financial hedge and a global necessity.
And then it starts to go sideways. Well, now you've established, and for some time, so now you've established a new trading range. It's far higher than the 40 that we're talking about now. Let's say it does what it did in 1980, it does kind of a triple, so you'd be looking like 120. And, the miners are happy. The manufacturers aren't really that sad because it's price inelastic on the demand side because they use so little silver per unit. There's not many ounces of silver in a flat screen TV or in a cell phone, or, unless you're talking silver jewelry, silverware, the silver used in industry per product use is very small cost-wise compared to the overall product, like a refrigerator, washing machine, television, you name it. So yeah, they might gripe and complain about it, but the truth of the matter is it's inelastic because it's essential. They can't do the product without it. And again, the overall cost of it being 120 an ounce may be great for a silver investor, but for a silver manufacturer, it doesn't want to. In most cases, there's a few.
When silver surges, big players notice. Warren Buffett once purchased nearly 130 million ounces, shaking the market. Today, pension funds, family offices, and institutional investors focus on liquid mining giants like Pan American or Wheaton Precious Metals. But during bull runs, psychology drives smaller investors toward penny stocks, tiny explorers promising the next big silver find. Many lack real value, yet hype sends them soaring. This creates a frenzy where a rising tide lifts all boats. Discerning investors must separate solid juniors with resources in the ground from speculative names riding the silver wave.
Big money, like Warren Buffett. I mean, when he bought silver, he bought 129.7 million ounces of silver off the COMEX. And he bought silver because buying Pan American, it would have taken the price to the moon. But, pension funds, family offices, or whatever, they'll be looking at the silver Wheatons, the Agnico Eagles, the Pan Americans, those type of things, because those are, billion-dollar, multi-billion-dollar companies that they can buy because they're liquid enough. But when silver runs, as you said, Jordan, there'll be any 5 cent, 7 cent, 12 cent stock that claims to be exploring for silver will take off. What happens is a psychological event. And people that are late to the party particularly will be looking for the cheapest silver stock they can find. And there'll be a lot of others that are of like mind. So you will see anything with silver in its name. Gold as well. I think they'll move together. They always do. And so what will happen is in those juniors, you will see a speculative frenzy. Now there's some juniors of merit, so you kind of got to, divide the wheat from the chaff. But as a general rule, high tide raises all boats. So from the moose pasture to the best, they're all going to go up.
Precious metals stocks don't always follow spot prices. They move on earnings. In 1980, many investors sold gold and silver stocks too soon, missing massive gains. As metal prices stayed high, mining profits exploded and share prices climbed long after bullion peaked. The same could happen again if silver reprices dramatically higher, say to $80 to $100, mining companies will see profits surge, making their stocks far more attractive than physical silver alone. Royalty firms, streamers, and producers stand to benefit most, but timing is everything. Selling too early could mean leaving fortunes on the table.
Now, going out in time, which I learned the hard way, is that, we both know that stocks are supposed to move on earnings. What a concept. I laugh because of the way the stock market is now. But in the golds in 1980, I blew it. I sold my gold, not all of it, but most of it, around the $700 level, and I let go of all my gold stocks nearly at the same time, which is a big mistake. Because gold, it just hit $300 an ounce in December of 1979. Well, now it's 6 months later, and we're in July, August, September of 1980, and the average price of gold is like 600. So that goes right to the bottom line. The margins were phenomenal. So those gold stocks just kept going up and up and up in price because they're based on earnings. And I sold them too soon. I could have got a lot better price. I could have collected dividends. Could have done a lot of things, but I got out and I was too naive, not experienced enough, whatever, to buy back in. So that will happen on the silvers as well. I mean, your royalty companies, your streamers, or those kind of things, depending on steady state conditions. So again, going from, we got a peak at $250 silver, $600 silver, we peaked at 600, and now it's at 200, or whatever the case may be. When it reprices, which I again think will be substantially higher than we are.
The silver market isn't just about bullion, it's about opportunity across tiers. Major miners, mid-tier producers, and speculative juniors all move differently. Consolidation has already begun. Mergers and acquisitions are quietly reshaping the sector. Juniors with proven reserves become prime takeover targets, rewarding early investors, though sometimes at undervalued prices. Meanwhile, institutional capital continues flowing into top-tier names while retail speculation floods small-cap explorers. As silver approaches its next explosive cycle, investors face the same old question: chase the frenzy or patiently build positions in companies with real merit? History suggests the patient often win.
That steady state condition of a trading range between, I don't know, pick a number, between 80 and 100, is going straight to the bottom line, and those stocks will be priced accordingly. So I will be doing my best with the Morgan Report, what to do with the top tier, those type of companies, what to do with the mid-tier, and obviously the speculations. It's all about timing. It's very difficult to do. The ones with merit, like we have a junior producers category we added a couple of years ago. Those are pretty cool because they are producing, they may be producing at a loss or very small margin, which gives them a lot of leverage. And then if they have enough in the ground, they're an M&A candidate, a merger and acquisition candidate. We've actually had 3 MAs already, and the market's not even that hot, which, I pat myself on the back or slap myself in the face. I say that metaphorically because, geez, you're a great stock picker, so you're getting a pat on the back, and then the members are on to slap you in the face because, we're not getting full value for these companies because these majors are taking out these stocks and they're getting them at a pretty good price because they've got, good amount of silver in the ground. They know what they're doing to get it out of the ground. But I can't control that. It does, it does fortify that we're picking companies of merit, but are they getting what they deserve price-wise? Again, I don't have control over it.